longer than a year. So these type of projects are extensive, capital intensive, and time intensive. And so we need to figure it out, how are we going to recognize revenue on these projects. So the most, common types of long-term contracts are construction projects, okay? We have an example here at the beginning of 2021. The Harding Construction Company received a contract to build an office building for $5 million. Okay, so this is going to be revenue for this project. All right. Harding will construct the building according to specifications provided by the buyer, and the project is estimated to take 3 years to complete. Okay, so it's a long-term project. So this means that we are going to recognize the revenue gradually. Now, how are we going to measure that? In this case, we're going to use a method called percentage of completion. Okay, and remember in one of those slides for this chapter we were looking at, it was looking at, okay, inbound versus, the inputs versus the outputs. So in this case, what we're looking at is, the inputs. Okay, we're looking at the inputs. We're looking at the costs that we have incurred year to date versus the total cost that we're estimating for this project. Okay, so when contractors come up with this revenue, they have also estimated the costs. Okay, so that's a bit troublesome, because if you have increasing cost, because you have a long term, right, anything could happen. It could be that minimum wage is raised. Okay, so that's going to add to the cost. It could be that fuel prices are going up, and so that also affect the cost. Okay, and we're going to be looking at certain scenarios where we actually have to recognize losses. So you have to really check the wording on these. So here we have the cost that was incurred during the year. So these costs here on the first row, they indicate the cost for that particular year. The second row is talking about prior years. Now the setup is not going to be the same for all of your problems. That's what I'm saying, that you have to read it carefully. So we have our total actual costs, okay? And then we estimate that, for example, for 2021, we're going to have an additional $2,250,000. So our total estimated and actual is $3,750,000, right? So right now, we, of course, if this was our total cost, we compare that to our $5 million, we can see that we're going to have a gross profit generated from this project. We have billings made during the year. That means our accounts receivable, right? When you say, every time you see billings, that means accounts receivable. And then, of course, the cash that we have collected, all right? So how we are going to recognize revenue is we're going to be using this little formula here, okay? We have our total estimated revenue. In this case was the 5 million, right? That was our total estimated revenue. We need to calculate a percentage completed to date, which I'm going to show that in the next slide. And then we're going to subtract the revenues that were recognized in prior periods. Now, for our first year, we don't have any prior periods. So for the first year, this is going to be 0. Okay. But for subsequent years, for 2022 and 23, then we're going to have to subtract the revenue that was recognized in previous years. And that will give us the amount of revenue that's recognized in the current period. So how do we calculate this percentage of completion? Okay, here we go, percentage of completion. We're going to take our actual cost divided by total cost, meaning estimated and actual. Okay, so in 2021, our actual cost was 1.5 million. Our total estimated and actual is 3,750,000. So if we take our 1.5 and divide it by the 3,750,000, we get 40%. So this means that we're 40% completed as far as costs are related to this project. Okay, this is the work that we've done. We've done 40% of the work. And so we're going to multiply the 5 million by the 40%, and that's where the 2 million comes from, okay, for 2021. So we take our 5 million and then multiply it by the rate to arrive at the 2 million, okay? And then for 2022, again, we take our actual cost divided by total cost, we arrive at the percentage. Now, this percentage in the second year is cumulative, okay? So this revenue here, we took this 62.5%, we multiplied it by 5 million to arrive at the 3,125,000. Now, this is cumulative, okay? It says here, cumulative, which means that we have to use that little formula that was in the previous slide where we have to subtract the 2 million to arrive at revenue generated or recognized in 2022. Now, if you notice in the third year, which is the final year, our percentage of completion, of course, is going to be 100%. So every time when it's the last year, it's going to be 100%. Okay, and so 100% that equals the 5 million, which was the revenue that was in the contract, but we're going to have to subtract previous year. So in that way, we come up with the revenue that's recognized in 2023. Okay, I think we have a slide that shows that calculation for, is that it? Was that it? Yeah. So we have the that was the 5 million multiplied by 40%. Should I write it down here? We have 5 million multiplied by 40%. In 2022, we have 5 million multiplied by 62.5%. And then the third year is the 5 million multiplied by 100%, right? So that's how we came out with these figures. And then if we want to calculate the current year, for the first year, of course, we don't have anything. So it will be the 2 million that we're recognizing. For 2022, we're going to subtract prior year and to arrive at the revenue recognized in 2022. Then for 2023, we subtract the 3,125,000 to arrive at 2023 revenue. Okay, so we have what the revenue will be recognized each year. And so if you add it together, it should add up to the 5 million. Okay, so going back. Now, so we did that. So now we go into the journal entries. Okay, the journal entries. Now, for a percentage of completion, we're going to have two new accounts. Okay, two new accounts. One is construction in progress. And construction in progress is an asset. Okay, so I'm going to put it's a balance sheet account and it's an asset. So just like any asset, it's going to be increased by debits and decreased by credits. Okay. And we have another new account called billings on construction contract. Okay. And billings on construction contract, we're going to say right now that it's a liability. Okay. We're going to say it's a liability on the balance sheet. But I'll show you how exactly we report this. So right now, just know that is a liability, meaning that credits increases it, debits decrease it. Okay. So in terms of the materials or the costs that were incurred for the construction in 2021, we are going to debit our construction in progress for this cost. Why are we debiting to the asset instead of an expense? Because this represents the monies that we are to collect from or the work that we have performed. So in a way, whoever the customer is, that person is gonna owe us that money, right? That person has an obligation to pay us for this work. All right, so this is the work that we have performed. We're gonna close this account at the end of the construction. When the construction is completed, we actually close the construction in progress and we close the billings account. So we're just using it right now as a conduit, okay, as a conduit. So for any cost that has to do with this contract, whether it is cash, materials, payroll for our workers, etc. So we're gonna use and debit that to the construction in progress, which is an asset account. And we do that for every year for the cost incurred for the current year, okay? Then we were told that the amount of billings, is it here? On the previous one, I think. We were told our billings made during the year were 1.2 million and 1.8 for per year, and then our cash collection. So that's just basically our accounts receivable. Okay, so when we bill our customer, instead of crediting sales revenue, for example, we are going to use this billings on construction contract account. Okay, we're gonna use this billing. It's kind of like deferred revenue, but we're not calling it that. All right, not exactly. So again, this account is gonna be closed again at the end of the construction once it's completed. So again, it's just a conduit. So to keep track of our billings. So we debit accounts receivable for the billings and we credit billings on construction. Okay, we do that every year. And then of course, just like always, you should be familiar with this entry. We receive the cash and we credit accounts receivable. So we decrease the receivable by the amount of cash that was received. So there's 1, 2, 3. We have 1, 2, 3 entries, and there's a fourth entry. So there's 4 entries for percentage of completion. Okay, so 2 and then 3. Okay. Our fourth entry, we're here. This is percentage of completion. This is completed contract. We'll put a pin on that, come back to that later. So we have 4 entries under percentage of completion. So the fourth entry is to recognize the revenue. Okay, we showed the calculation just a minute prior. We show the cost, okay, the expense of our construction, all right? And then we are going to debit, again, this is an asset account. This is an asset. We are debiting our gross profit, okay? So gross profit is revenues minus cost of goods equals gross profit. The same thing here, okay? So we have our revenue, we have our cost of construction, and that equals our gross profit. But we're debiting our gross profit to construction in progress. Okay, I'm just gonna put GP here. That means gross profit. Okay, and we do that every year. Every year. Okay. So, what's happening here? Well, we already showed that. Okay, so we said once that the construction is finalized, okay, we have a final product now at the end of 2023, then we're going to close. Remember, this was an asset account and this was a liability account. And I know we only close income statement accounts. We've been saying this ever since BA 200. So this is an anomaly, okay? But is an anomaly specific to percentage of completion and also completed contract as well. So it has to do with the recognition of revenue for long-term contracts. Okay. So we are closing the construction in progress. We're crediting the 5 million, and we're closing the billings on construction contract. So we're debiting the liability. This closes these two accounts. Okay, let me see if they show the T account for those. No, okay. Maybe they did in the previous slide, but we couldn't really see it very well. In terms of the financial statements, on the income statement, this is income statement, we have per year our revenue that was recognized under percentage of completion, our cost for the year, and then the gross profit that was recognized. Okay, so this is the income statement, or I guess partial income statement. And then we have our balance sheet. Okay, our balance sheet. Now, on the balance sheet, the treatment is a bit different. Remember, construction in progress is an asset, right? So if our construction in progress, the balance at the end of the year is greater than the billings on contract, then we report the net amount as an asset. Okay, we report the net amount as an asset. Okay, so I'm looking here. Okay, this is our percentage of completion right here. This is percentage of completion. They combined it with the other method. We'll put a pin on that. I'll talk about that later. But here we can see, or actually it's a bit confusing because it's not actually reported. But here we can see in 2021, our construction in progress was 2 million and the billings was 1.2. So we reported the net 800,000 as an asset. Okay. Now, I think it's the following year, in 2022, our billings, the balance of our billings at the end of the year was greater than our construction in progress account. Therefore, we reported it as a net liability. Okay, so that brings me to the next one. So if CIP or if billings is greater than CIP, then we report a net liability. Okay, the reason for that is we are saying we billed our customer too much on work that we haven't done yet. Therefore, this is our obligation now to perform this work. Okay. The other, where the CIP is greater than billings, is a net asset because we perform more work than we have billed our customer. Therefore, they still owe us, and so it's reported as a net asset. Okay. Any questions so far? Okay. No head spinning or anything. Okay. Now we talked about the completion method. Okay. Upon completion method. So there's another method called upon completion. And usually the default method is percentage of completion. But if there's too much uncertainty as to the progression of this contract, the cost, the ability for the client to pay, and other considerations, then we can use upon completion. The upon completion method has only the journal entries 1, 2, 3, and for number 4, it delays the recognition of revenue until the project is actually completed. Okay, so instead of gradually recognizing the revenue as we did here, as we progress through the work that we've done under percentage of completion, upon completion method, we're just gonna delay that until we have a final product. Okay. And again, upon completion is not really GAAP, because remember that we have to match our revenues and expenses. So it's only used under certain circumstances. So this upper portion of this illustration was showing how do we report under upon completion rather than percentage of completion. So in terms of your exam, the focus should be on percentage of completion, of course, but you should have an understanding of when do we use upon completion, okay? Yeah, so as mentioned before, if there's a lot of uncertainty as to the cost and when it's going to be completed, or maybe through the pandemic, right? I mean, they have to stop work, then you don't know when exactly we're going to start work again. Sometimes it's difficult to find people who are, experiencing construction to work, etc. So a lot of difficulties. So maybe you want to just delay the revenue recognition until it's completed. Okay, there's a lot of uncertainty. Okay. All right. Now we come to, so the example that we showed, it was all gross profit throughout the years and even for the overall contract. Okay. So there are situations like we said, right? We have a rise in cost. We have, wages or wages that are increasing. We may have fuel costs. We may have other costs that are going to affect or eat into our profit. And so there is going to make a difference on how we treat it for financial purposes. So we have, for example, there are 2 types of losses. One is the periodic loss. So just for that year, we had 3 years or 4 years or 5 years. Just for 1 or 2 years, maybe we have a loss, but overall we still have gross profit. Okay, that will be a periodic loss. Overall loss means that, we pretty much miscalculated our cost. We have a huge rise in cost, and so now we have no profit generated from this project. Okay, it's a total loss. So how it is, the different situations is going to make a difference on how we recognize it for financial purposes. So we have an example. We're still working with the same example, except that our costs are now greater than what they were before. Okay, and so for 2022, we have our actual cost divided by our total cost, which is estimated and actual. We come out with a 60% percentage of completion. We multiply by the 5 million, subtract 2021 revenue recognition, and we have revenues of $1 million. So revenues of $1 million will be recognized in 20. However, our cost for the year is $1,260,000, which means that if I were to report this on the income statement, right, I'll have my revenue for 1 million, and then less the cost of construction. In this case, is going to be 1,260,000. So my cost exceeds my revenue, therefore I end up with a loss of 260. Okay. However, if you look at 2023, remember that it was 5 million, right? 5 million is the revenue overall, because 2023 is 100%. Overall, all of my costs are 4.6. So overall, I still have 400,000 of profit in this project. But for that year, 2022, I'm going to report a loss. So all we do is we have our cost of construction, which is an income statement account. Income statement account, we treat it as an expense. Okay, a debit to that for the amount of our costs. Our revenues for $1 million, which we figured out here. And then instead of debiting construction in progress as we did before, because we had a gross profit, we're going to credit construction in progress. And remember, construction in progress is an asset. Okay? Because we have a loss, we're decreasing it instead of increasing it. And that's it. And then we move on as we did with the previous example for the third year. Oops, sorry, not this one. For the third year, so nothing changes there except for the fourth journal entry. Okay, so that's just a loss for a period versus the loss for the entire project. Okay, the loss for the entire project, it gets a bit funky and students usually freak out, but there's really nothing to it. Okay, so 2021, we have the same numbers that we did before. So we know that we're going to recognize a gross profit. I think it was 500,000, right? It's here. We recognized a gross profit of 500,000 in 2021. That calculation was done in previous slides. Now note 2022, we are estimating and actual costs are 5.1 million. Okay, so that means that now this actually exceeds our $5 million that we agreed to get revenues for this contract with our customer. Okay, sometimes you may be able to renegotiate, okay, if you're in a construction company, but sometimes you will not be able to. That means that you're going to have to eat this loss, all right? And so you can see that 100%, right? It was 100%. You can see our total cost of 5.2. So it looks like we're now estimating a total loss, overall loss for this project of 200,000. Okay, of 200,000. So after we're done crying, we are going to deal with the financial part of this. All right. So we have you already have this from 2021. We already is the same calculation that we did previously. So again, we have to calculate our percentage of completion. So we have the cost, actual cost divided by total, which is actual plus estimated. We have our percentage. We have, we multiply it by the 5 million. We subtract the prior year revenue recognition, and we come up with the amount of revenues that we're recognizing. Now, since we are netting, okay, let me just take here. 5 million is the revenues, right? Oops. Revenues are 5 million. Okay, that's too big. Let's see. Revenues are 5 million. Okay, revenues are 5 million. Our costs are 5.1. That means that our loss is 100,000. Okay? So once that we know that we have an overall loss for this project, we have to recognize that loss. Okay? We forget percentage of completion. We have to recognize the loss. So in order to recognize a loss of 100,000 cumulative between prior what we reported in the prior year and what we're reporting in the current, so I'm gonna plug my expenses to make it what it needs to be. Okay, so here we are going to net 100,000. Okay, so if we take $600,000 loss and add it to the 500,000 gross profit that we reported the year prior, cumulative is gonna be a loss of 100,000. Okay, so we had to plug our cost. So this cost, that's why this cost is different from this cost. Okay, or the 1,260,000. That's why, because we're trying to make it so that combined loss is going to tie to the loss that we're supposed to recognize. And then for the last year, we don't have to do, well, actually, yes, we have to plug. We have to plug once again. Oops. And accountants love that word. Just plug the difference. Okay. And so we have the revenue that was recognized up to date. This is 2023. The revenues that were recognized in the past, okay, subtracted. We have the revenue that needs to be recognized in 2023. But when it comes to the cost, we're not reflecting the 2,440,000. We're plugging that difference to be the 100,000 that, remember, if we take 5.2 and we subtract, we have another 100,000 here, right? 5.2 subtract by the 5.1, we have another $100,000 loss that we need to recognize. So in essence, the combination of these losses, right? We said if we're looking at overall, we have $200,000 loss in this project. Okay, 100,000 here netted from the 2 years, and then another 100,000 for the third year. That's 200,000 for this project. Okay, was that crazy or what? Okay. And every time we have a loss, we're going to credit construction in progress rather than debit. Okay. All right. Okay, and that pretty much concludes